This is TreppWire Week in Review for week ending June 17th, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Henry, Head of CRE and Advisory Services. This week, the Federal Reserve raised interest rates by 0.75 of a percentage point on the heels of hotter than expected consumer inflation data released last Friday. A slew of other economic data reveal a weakening housing market, a slowing in spending as retail sales logged their first drop in months, and a consumer sentiment that plunged in early June to the lowest level on record. Manus, investors rallied on the aftermath of the Fed decision Wednesday, but that was a different story a day later. What happened?
Well, that rally didn't last very long, did it? Right? We got the news at 2 p.m. on Wednesday. We saw a lot of volatility in the last 2 hours, a lot of ups and downs. Stocks finally finished up, but by the futures this morning, they were deeply in the red. The indexes really tumbled right out of the gate and almost never made any kind of stand. Maybe you could say they pared their losses modestly over the last hour, but that's really kind of putting lipstick on a pig. It's been a brutal week, and you've talked a lot about it. CPI much hotter than expected. It's funny, just a week ago, there was about half of the market kind of telling this narrative that we had seen peak inflation, that we were not going to see a higher CPI number going forward than, what we had seen in March and April. And I would say people were pretty sanguine at that point. Then we get the CPI drop on Friday morning, and the entire tone of the market just turns around. Interest rates spike, mortgage rates spike. The Dow over the next couple sessions is down about 3,000 points over 4 trading sessions. We talked about the consumer sentiment index at an all-time low, and I think that people are rattled at this point. We'll give you a couple of other anecdotes about the last week that we saw. The 30-year fixed rate residential mortgage at one point was up from 550 last week to 628 at one point during this week. Since then, it's come down about 20 basis points, but a staggering move, 78 basis points over the course of the week, and that's likely to slow down the housing sales market for sure. At one point on Friday, we were getting texts and Twitter messages and so forth that the resi market had frozen, that there were no bid situations for resi paper because people were so worried about extension risk that money managers had no interest in resi paper on Friday. Really an unprecedented thing. One of the things I thought was very market moving last night was Double Line's Jeffrey Gundlach came on after the closing bell and really painted a bearish picture of the market. He said the Fed is so far behind the curve that they should have raised short-term interest rates to 3% immediately, that there's no point waiting to September to get there, and that there are no places in the economy that you can look to right now that are potential drivers of growth. And I do think that a guy that's respected like he is, somebody with a big audience that he does through his podcasts and through his media appearances, made an impact yesterday. But we have a lot to uncover today. We have so many layers of the onion to peel back. Hopefully we can make sense of everything that took place and buckle up.
Yeah, I know we have a lot to get to today, man, and so I won't fill in with too many additional bullets here, but a couple of things to piggyback on what you said. Housing starts fell 14% in May from the prior month, which was the lowest level in over a year. It's 3.5% below the same time last year. Building permit, proxy for new construction, fell to an annualized 1.7 million units, which was an 8-month low. You couple that with the mortgage interest rate data that you threw out, we started to see a few immediate impacts felt there. Redfin announced they were going to cut 8% of their employee base. And Compass, who's been in the news recently for not hitting expectations, announced they were going to cut 10% of their workforce. So we're actually seeing, that play out in real time in the residential space. And then I think the other thing worth mentioning is the consumer sentiment. We've talked about this pretty much on every pod for the last 6 or 7 weeks. Plunged in early June, lowest on record, continued to be battered by inflation and news, et cetera, et cetera. So numbers on that, the June sentiment index fell to 50.2%, down from 58.4% in May. And that was from last Friday's data. So a lot to cover today. Things are starting to fall a little bit at this point. We don't know. We've been talking a little bit about uncertainty from a bunch of different geopolitical and macro factors. And now we're starting to see some of this stuff hit in the real estate space specifically.
Because we have so much to go through this week, let me set expectations a little bit. We did attend a conference this week in New York. It was the CREFC Trade Organization Conference. It stands for the Commercial Real Estate Finance Council. It's been around for a long time. They threw 2 conferences a year. And one of the benefits of us being there was to be able to hear firsthand what the sentiment was and what the tone was. So as we go through the rest of this podcast, because there's so much to go through, to line it up for you, the first part of it, we're going to talk about what people were saying at the conference in general, what the tone was, what they think the changes are to the market, and what they think the impact of a higher rate scenario or environment is, what that will mean for CRE, and what a potential recession might mean should higher rates trigger a recession. So we'll go through that sentiment first, and that is really kind of other people's opinions. Then Martha, Lonnie, and I will go through kind of where we think we sit. That'll be more, we don't editorialize a whole lot on this podcast, but we will give our own thoughts about what we think the market is. And then we will give you a whole boatload of crabgrass and Greenshoots so you can kind of make your own decisions about where you think things are. So like I said, buckle up and hopefully we can make sense of this. I don't think we've ever had more information and things to go through than we do this week. So Martha, Lonnie, you ready?
Let's do it.
Do you want to start with impact to CRE, which combines a little bit, I think, of some of the events that happened in the news regarding economic data that was released, as well as some of the conversations with some of the folks at CREFC?
Yeah, let's start there. I think that's a terrific place to be, to just set the tone. People that are kind of tourists in the rate market, just a couple of numbers here. Over the last week, and these are not up-to-date numbers, we said I don't have today's numbers, but at one point, the one-year treasury had gone from 226 to 315. So almost 100 basis point move in yield. The 2-year was up 70 basis points at one point. It's now up about 55 basis points week over week, factoring in the fact that rates have come down a little bit the last couple of days. And the 10-year went from under 3% to as high as 350. So that's what we're talking about right now. So if you haven't been following these things that closely, that was on the minds of people this week in New York and what that impact is. So we try to break it up into a couple different categories, what these higher rates will mean for borrowers, lenders, and CMBS investors. So I'll start off with, the bullet points of what is likely, or what we heard in CREFC, and we kind of agree with these things, will happen from the borrower's perspective. Clearly, with higher rates, borrowers are going to be paying a higher coupon to refinance now than they were certainly 2 weeks ago, 4 weeks ago, 8 weeks ago. Depending on when they look the last, the sticker shock will be either extreme or very extreme. Some borrowers will have to write checks for the first time in a long time to refinance. So maybe a guy or a gal has a $100 million loan. They were thinking, based on interest rates 6 months ago and valuations, they were going to be able to refinance into a $120 million loan and put $20 million in cash in their pocket. Now maybe because of higher interest rates, they might be looking at having to write a $10 million check to refinance that $100 million loan. That's what we talk about when we say borrowers have to write checks. If there's enough negative equity in a property, meaning because of the new rate environment and lower valuations, if there's lower equity or no equity or negative equity, borrowers may walk away, right? That would lead to an uptick in delinquencies and defaults. If that's going to happen, it's probably not going to happen until the maturity of the loan, right? If the property is cash flow positive, the borrower, like they did with the malls, will hold on to it until such time as the loan matures. DSCR levels will be materially lower, as the new rate will cause the DSCR denominator to rise. You have the same revenue, presumably, or the same NOI, but you have a higher cost, which means that as you calculate DSCR levels on a new loan, they will be lower, maybe as much as 40 ticks. Right? A 170x DSCR may turn into a 135x DSCR. And for some refinancings, that could mean, cuspy properties, cuspy loans, the borrower throws in the towel, right? So those are some of the impacts on the borrowers that I think are universally accepted and were universally accepted at the CREFC conference this week.
Yeah, I think the one takeaway here, Manus, is that some of these things may be felt immediately, while others maybe are not going to be felt right away, but the writing's on the wall. So, if you were a borrower that took out a loan 3 years ago and you're coming up on a maturity date, you probably didn't underwrite a 200 basis point increase in your interest expense if you had to refinance. Those folks that have upcoming maturities, they're probably pretty nervous at this point. If you are looking to acquire property and you've been, monitoring the market over the last couple of weeks, you probably have had some expectation of reality setting in on what rates are. If you're a seller, we didn't really talk about that, but on the sell side, these impacts to the borrowers are then going to drive the price down that they're able to pay. So, this is kind of a two-sided coin here. The borrowers are going to be impacted with having access to less capital. The lenders are going to be more protective on their underwriting, but that ultimately impacts the seller and what they're going to be able to command in the marketplace. And so we've seen a lot of chatter online about deals that were purported to have multiple offers or best and final a few months ago still being on the market and for sale, and so borrowers not able to actually go through with what they had contracted on. You hit on a couple of other interesting things that we probably haven't talked about in depth because of the bull market we've been in, but for a lot of these syndicated deals or GP/LP type of structures, some of these LPs have never had to make a capital call of their investors. Every correspondence they've had from their initial investment, whether they've sold the initial property or they've gone into a new investment, everything's been positive. The returns have probably exceeded expectations. All the LPs are super excited and willing to throw more money into the next deal. And we're maybe going to start seeing a little bit of turn there. So like you're saying, if someone has to come to the table with a $10 million check to refi, some of those LPs probably are cutting that check, and that's a different conversation from a GP perspective. So those things have ripple effects. We've seen the compounding, the benefit of compounding in the sense that GPs that have outperformed have been able to raise additional capital for new deals, but those same folks that maybe have to start calling on their investors for capital, we'll see if there's a similar compound on the negative where some of that capital dries up and there's less people in the marketplace.
A couple more thoughts on the borrower side that we noticed. Really no place to hide in the term of the loan. Historically, you could save a few basis points or many basis points taking a 5-year loan or a floater instead of 10-year fixed. Because the 1 year is really on top of the 5-year is on top of the 10-year, there's nowhere to hide. You can't get a materially lower interest rate going floating right now or going 5-year. You'll save a few basis points, but it's not going to be 75 basis points, right? Or 100 basis points, right? That is gone. Because of the sell-off in equities, the volatility and the change in sentiment was so ferocious and so quick this week that we don't really have transactions that reflect cap rates and comps that really tell us about what the new normal is, right? So if you're on the borrower side and you see a sale that was announced 4 days ago, that sale was probably in the works a month ago, right? So if you point to that and you say, well, that was done at a 375 cap, I think your lender is going to say, or your potential seller or buyer is going to say, yeah, that was 2 weeks ago, right? That was 150 basis points ago. And you can't rely on that. And the general sentiment from the people in New York this week was that both cap rates and likely spreads, credit spreads, really have a lot of catching up to do over the next couple of weeks based on the volatility and the sentiment in the markets.
Yeah, I think that's a valid point. The question will be, has this shift been so dramatic that it halts transactions? So, it's not like there's a gradual decline or deceleration in transactions to where in 6 weeks we're having a conversation and we have a clearer understanding of cap rates. This has been such a significant increase in cost of capital that you may see actual, a stopping of transactions, which just puts the market in even a worse quandary where people don't really know at that point where the market is. Like to your point, Manus, if you close something that was under contract, 6 weeks ago, you probably know that that's maybe 100, 150 basis points lower than what it would be today. But if we go another 6 or 8 weeks with very limited transaction data, that gets a little bit murkier on what that floor is. So that's something we should definitely keep an eye on. We had some comments last week on the pod about transaction volume slowing down. I think we referenced an article from CRE Direct. That was before all of this took place this week. It'll be very interesting just to see what the knockoff effects are here as it pertains to transactions.
So Martha, I called it as we were walking out of there, gloom and doom, almost from the get-go on Monday morning. Give us your thoughts. Do you agree with that? Was that the tone you were getting from the attendees at the Marriott Marquis in Times Square?
I think it definitely turned that way. There was a measured response to people's comments, I think, early on Monday when I sat through some of the sessions and talked to some of the attendees. And I will say that as that day closed out, people were getting much more vocal on their negative feelings and being direct about, some of the comments they made. It was interesting. And I know, Manus, you and I spoke about this. There wasn't a whole lot of data presented at this meeting this week. And, perhaps it's because most of that data is looking in the rearview mirror at this point and not really giving you any forward-looking confidence or indicators. So there was a lot of discussion that really focused on sentiment and what people were seeing currently, and not a whole lot of real statistical review of what had happened in, say, the last 6 months or so.
Right. That's spot on. The one guy that did give us some stats was a gentleman named Ed Reardon from Deutsche Bank. Unfortunately, we're not at liberty to give away his stuff, but he's a really sharp guy, and he kind of painted the picture for us of cap rate direction and spread direction and so forth. And if you get on his mailing list for research, if you're an accredited investor, puts out some good stuff every week. But you're right. It was largely anecdotal, and that kind of leads into the next part of the conversation that we're going to talk about is, what does this mean? We talked about what this means for borrowers. What does this mean for lenders, right? Banks, CMBS issuers, private equity, and so forth. Because balance sheet lenders do not have the obligation that CMBS issuers have to immediately price loans in a way that they know they can securitize. Balance sheet lenders can adjust their risk spreads at a slower rate and don't have to react to every move in spreads immediately. And what that means is that, if we've seen 100 basis point widening in BBB minus and a 20 basis point widening in AAA, CMBS lenders, issuers, have to reflect that immediately. Otherwise, they will not be able to securitize their deals at a profit, right? So any risk premium move, they need to reflect right away. The balance sheet lender, they can take a little bit more time. So this may be a moment where balance sheet lenders pick up market share here, because they could be a little bit more gradual and say, we want to use this as an opportunity to put more money to work. We'll see if that's the case. Other things from the lenders, it had been said repeatedly at the conference this week that lenders are having, quote unquote, difficult conversations with borrowers. That strikes us as a euphemism for either we're not going to be able to make this loan at that spread, or we're not going to be able to give you the proceeds you thought you were going to get because of current conditions. And to Lonnie's point earlier, that could mean at some point people walk away, right? Lenders say, we're not doing loans anymore because we're having too many difficult conversations, or borrowers say, we're going to wait it out and we'll come back to you in a few weeks, or we'll go elsewhere. We'll go to the balance sheet guy. So we'll see. That's kind of the lender perspective.
Yeah. So there was some commentary on Twitter today. Matthew G was out saying that a large life co had basically said they're going to stop making loans until they get a little more certainty from the market. And then there were some comments about a few other folks saying that other large lenders were effectively de facto doing the same thing, but without vocalizing or verbalizing it. But their term sheets were such that they were really discouraging borrowers from being able to move forward. And so, one piece of advice here would just be, if you are a borrower in today's environment, you can't take the terms for granted. You have to read all the small fine print in the term sheets and everything else, because to your point, Manus, until something's closed, a lot of times there can be changes and modifications and upticks and other things. And we've seen a lot of borrowers, or heard or read about a lot of borrowers that get to the closing table or right before and realize that their rates have been changed. And you have to be proactive in this type of environment. Unfortunately, every small detail does matter.
I'm a little bit surprised to hear that remark that you made about life cos, because I kind of put life cos in the same bucket as balance sheet lenders, right? Life cos for years have been starved for yield. They don't have the mark-to-market obligation, right? As long as they're matching liabilities to assets in terms of length, right? What they have to pay out in their obligations to, what they invest in terms of duration, they're okay. To hear them pulling back is a little bit concerning.
Yeah, he didn't list which life company, but he just said one major life company lender moving to the sidelines for the moment. His advice was be careful out there. So, I think we'll start seeing these things become more prevalent. I mean, we all know lenders like certainty. They like predictable outcomes. They like having some faith that what they've underwritten is going to take place. And with all of the moving parts that we're seeing right now, the one thing that we know for sure is that there's a lot more uncertainty in the marketplace.
And moving on to the last leg in the stool, we'll talk about what this means for CMBS investors. We'll go through this quickly because we know a lot of our audience is not just CMBS, it's more commercial real estate. CMBS investors should assume that those borrowers who have loan extension options will choose to extend, right? They will keep that low interest rate spread locked in as long as they can. There's no point in refinancing if you have a low rate in hand and you have 2 or 3 more 12-month extension options. So CMBS investors should trade bonds assuming all these loans extend to max, right? That should be your scenario. Because CMBS investors right now out of the money, they now have coupons that are below the market, especially earlier AAA bonds. Because of economic conditions, they may not get their principal back nearly as quickly as they thought they were. So they get the double whammy of out of the money coupon, and you're getting your money back slower because nobody's refinancing. And even worse, maybe people are extending and pretending more, right? Not just in the mall space, but in the office space and in other places. And then lastly, maturity defaults should tick up, right? As loans get to the maturity date, we may see guys just go down that same mall path, which is let's go into that period where we keep making our interest payment and we let the special servicer come to us, right? We'd rather keep this 3.5% loan and pay a 1% special servicing fee and maybe pay some other legal fees than have to refinance into a 6, right? This may be a strategic default that certain borrowers take just because they've seen it take place in the mall space. And they say, we can get 12 months of negotiating window and let this roll. We'll see. That's speculative.
Yeah, I would say the one silver lining from everything we've touched on today, man, this is just the news on interest rates, some of the other macro, challenges we've identified. Doesn't mean necessarily that people quit paying rent. It doesn't mean that property owners aren't able to increase rent in certain markets. So, there's still going to be a lot of properties that perform just fine. We've seen a lot of stuff across multifamily and other asset classes where rental rates are still growing significantly. So, while these may be challenging for a small subset of the marketplace, a lot of these properties, they're probably just not going to hit certain hurdles on their IRR or their, other investor promote structure. But all in all, they're not going to become a delinquency. They're not going to become a default, and they still may be able to get out of the asset when it's time for them to go ahead and sell.
Before we move on to opinions, any other thoughts, Martha, on CREFC?
Yeah, I had a lot of notes actually that I gathered, and a lot of them you've covered with some of the things you said. One of the things I noted is that while there definitely was a pall over, some of the mood, there wasn't a panic of any kind. And it almost seemed like people were willing to have a wait and see attitude to measure, and kind of weather this out. And I think that says something, that people feel they're in a better position, capital available to be deployed. They're willing to wait for the right asset. So I think that was encouraging.
Yeah, I think there has been no panic in the market yet. We still see deals coming to market. The widening of spreads has been orderly. We haven't seen a no bid situation like we've seen in the resi space thus far. And I think that's spot on. I would say it was doom and gloom, but not panic. That's a positive sign. We'll roll into the opinion side of this. I'll throw out my opinions. Martha and Lonnie can throw in theirs as well. As I said at the open, we don't editorialize a whole lot. So maybe, we'll get some responses back and we'll talk about those next week. But here goes, lots of talk this week about sharply higher default rates, falling valuations, compressed DSCR, lower proceeds, wider spreads, higher cap rates, surging borrower expenses. We haven't talked about that before, but that was a recurring theme this week. Higher energy costs, higher ESG conversion costs, much higher TI expenses, and so forth. That was a common theme, that in addition to paying a higher interest rate and in addition to paying a higher spread or getting lower proceeds, the expectation is that reserves will have to go up to account for what will be much more expensive replacement costs down the road. Offices were singled out as a huge area of concern, especially B and C class offices. Some said that B and C offices, and this is something that Lonnie posited a couple weeks ago, they will go down the same path as B and C malls, right? And we will see a huge reckoning in the B and C office space. There were a few at the conference that tried to make a less bearish case. They relied really exclusively on the enormous amount of capital on the sideline waiting to be deployed. Someone said it was north of $400 billion out there. But by and large, I thought it was decidedly bearish. My opinion is that the glass is not nearly as half empty as the CREFC crowd would have us believe. I think there was a lot of recency bias in the CPI print and the stock market sell-off that took place on Monday when we were at the conference. I think that had a big component to the gloom and doom. And I think that if the conference had happened before the CPI print, it wouldn't have been nearly as downcast as it was. And why do I think the glass is not nearly as half empty as maybe the CREFC crowd would have us believe? Well, we've had two real collapses in CRE in the last 35 years. One was in the early 90s, and one was in that 2008 to 2010 period. In both cases, we had two similarities, right? Going into the crisis, underwriting hygiene was terrible. People were making really loose loans at incredibly inflated values with very little skin in the game. And at the same time, there wasn't a lot of liquidity. And banks, who are big parts of the CRE market, were not incredibly capitalized like they are today. So that was a recipe for the two disasters that we've seen over the last 35 years. We've seen several other mini shocks to the system, and that would be the Russian debt crisis, the dot-com bust, post 9/11, the energy bust, and the beginning of COVID, where the trough was incredibly shallow. Buyers came out of the woodwork very quickly, rebid up prices really quickly, and put money to work. I do think that that's where we are in this market. Hygiene was not terrible coming into this period. LTVs were not 85 or 90 like they were in 2008, 2007. Banks are really well capitalized, and there's a lot of money out there. So that's my glass half full case. And, come at me if you think differently via email, but just remember, it's always just business, not personal.
Well, I was feeling a little doom and gloom when you started, Manus, but I think you rallied me at the end there. I mean, I would say a couple of, I think, distinct differences. So you mentioned kind of the savings and loans crisis and the Great Recession. Those were liquidity, events where it was really hard to get capital. In addition to the dry powder on the sidelines that everyone keeps referencing, right, which we think is real, we just don't know necessarily how to quantify that. You have a lot of non-bank lenders that have really entered this space now that diversify that capital pool. So in the past, you're maybe limited in your optionality as a borrower of only being able to get capital from certain sources, and now that's significantly diversified. So maybe the terms, the rates, the other things are not as favorable as a borrower, but there is an outlet for you to find capital to then extend and pretend or do what you need to do in the interim during a downturn. So I think that's one of the major differences that would maybe give me some optimism going forward. The other thing is that there's been a lot more government intervention in the marketplace more recently than there was in both savings and loans and the Great Financial Crisis. So ultimately in the GFC, government ended up buying the bank's toxic assets and selling them off. But here, when COVID hit, we had PPP, we had all this other intervention that really kind of staved off some of the downturn that probably would have been felt. So I think there's some consumer sentiment from deal makers that, there's a little bit more of a safety net than maybe there would have been in the past. Maybe a short-term good, long-term bad. We'll see how that plays out. So that's probably part of the reason we have some of the inflationary costs that we have now. But those are two things that I think are a little bit different. I don't think in either instance, though, that it's going to negate some of the pain for the office sector. We've talked about that at length, the haves and the have-nots. I think we still see that play out. The one contrarian view for me on that is, and I've seen this in multiple locations, is if we enter a recession and people start feeling like they may lose their job, that may put an impetus on them to come back to the office. And if that happens, then that maybe saves some of this office doom and gloom for another time. Because if 70% of the workforce comes back in the office, then maybe some of these, B and C office buildings become a little bit more viable for the short term. So I think that's something we'll have to wait and see, but I could see that potentially playing out. Some of the other sectors like retail specifically, I think there's definitely some risk there. And we've seen that. I think you wrote a piece that we put in CRE Direct last week that kind of went through and looked at what happens to debt service coverage ratios and other things based on interest rates. And the retail sector jumped out there as having potentially the highest risk in terms of defaults based on DSCR coverage. So, I think that would be the other sector we'd keep an eye on. I think for these others, though, we're probably in pretty good shape. I mean, industrial, even if it cools down, if you bought an industrial property 36 months ago, the rental rate increases you've seen over the last 36 months give you a buffer. Even if values come down, you're probably okay from a cash flow perspective. Multifamily's been really strong. There'll be some distress for these folks that bought in at the latter end of the cycle to try to do value add. But if they have extension options and other things available, they'll just use those until they can't any longer. So I'm cautiously optimistic, I would say, at this point. I think for those of us that follow the market at the level we do, the macro news could be really scary. And if you let those things compound, it does spell doom and gloom. But if you follow the folks that are making deals in the market, the buyers and sellers that are actually transacting, they're slowing down a little. They're underwriting a little more cautiously. They're not promising returns at the level that they were, but they're still looking and they're still confident there's deals out there. So I think in this instance, as long as the capital's there, we're going to be just fine. See, some winners, some losers in some of those sectors we talked about, office and retail. But overall, I think we're going to be okay.
Before we get to Martha's opinion, I just want to throw out two caveats to what I said before, or two addendums.
You're already backtracking on what you
said. No, I'm not
backtracking. The show's not even over.
No, I'm not backtracking.
All right.
My first point is that lest people think that I am a perma bull, back in 2007, I certainly felt like what people were doing was nuts. Was not afraid to say so when they were securitizing synthetic tranches into synthetic CDOs, and when they were doing pro forma lending with an in-place DSCR of 0.50x and a huge reserve meant to bridge the gap while a business plan was put forth. I would also say that assessment of the glass not as empty as people think it is doesn't mean that there won't be pain, right? There will be lower valuations. There will be some more defaults. There will be higher cap rates. There will be extend and pretend. I'm not saying there won't be any of that. I just don't think it will be as bad as the sentiment I was getting from people on the panels this week in New York. Martha?
Yeah, I think my opinion is going to be dependent on the data that we see, like we've seen over the last 2 years, right? So we've spent the better part of the last 2 years every week digging into what we see in the market and then reporting on that both in TreppWire and in the podcast. And, one of the things we've talked about for a long time is this bifurcation of the market, where you've had parts of the market that did very well and other parts, obviously, that, were languishing and eventually didn't make it. I don't think this will be any different. I think you will see some sectors like we've seen that were the darling of the pandemic be able to survive this next wave. And one of the things I thought was an interesting comment, I know we've talked about this when we talk about various stories that we cover every week, that office in mediocre markets is going to be a bigger problem than the interest rates. So, the things that we've covered every week where you've seen some sky high transactions that did really well, and then you've got others that were sold at a loss. So I don't think this will be any different. I think what will be different, though, is what I had said before, where I don't see a whole lot of panic. I think it's a little bit more organized in terms of what you're seeing. And I don't know, when we're talking about some of these, and we'll talk about them shortly in a minute, some of these Greenshoots and Crabgrass, you start to see this kind of sorting out of those that somehow make it through and others that don't.
I agree. And I think if one thing was taught to us over the last 2 years is that no property segment is a monolith, right? People talked about retail, the retail apocalypse and so forth. And they talked about the malls being a disaster. And in some cases they were, but the malls make up a fraction of the entire retail segment, right? And what we saw was malls suffered for sure over the last 2 years, but other parts of retail really surged, grocery anchored and those shopping centers that I still can't explain, right? The one with Joann's and Marshall's and Burlington, that still mystifies me. It did very well. And I think the same thing is true here in office. There's this sentiment out there right now that B&C office is B&C mall. And fine, you could make that thesis, that's a defensible thesis, but I think that B&C office is not the entire office market, number one. And I do think that you will see vastly, vastly different outcomes in cities with long commutes and higher environmental regulations and lower quality of life standards than you will in other areas. Salt Lake City, Austin, Tampa, Charlotte will behave much, much differently than New York, San Francisco, and Chicago, right? And it's important, especially for CMBS guys, where diversification is the key, that kind of understand that subtlety.
One other thing to look at is the outcomes are no longer binary. It's not that a loan either pays off or it gets foreclosed on. This extend and pretend has kind of moved the goalpost a little bit in the sense that you can kind of get a soft landing or an amenable, reconciliation of something that doesn't meet the covenants and, goes past maturity or whatever. And so if you look at things, if they were implemented to the letter of the loan agreement, there's a binary outcome. They either pay off or they don't. They either refinance or they don't. In today's age, it seems like people are more willing to do the extend and pretend, which I do think eliminates some of that panic Martha was talking about. Because now if you have something that's coming up, but you feel like, the lender feels like you're making efforts, there's really no market to sell it, the servicer's willing to work with you in our universe, et cetera. Like it's allowed for a slightly less panic type of approach to these scenarios.
This was like Lonnie in high school, where his parents would say, you got to be in by 11:30, but 11:30 wasn't really that hard deadline, right? They would, as long as you were within, 20 minutes of that 11:30, or you were in the same zip code by 11:30, right? Or you were pulled in and you were sitting in the driveway listening to your rap music, you kind of met the letter of the law. Is that kind of what it's like, Lonnie?
Yeah, I wish
Martha
I was
too. You probably had the same experience.
Oh no, mine was much stricter.
I was going to say, I wish I was that cool, but I was a homebody, so I was always home by like 11:30. I was not out. Now my brother, we could have a whole segment on him. He pushed the limit every time, but I was usually at home. I didn't have any reason to be out. I wasn't that cool.
Well, our rule was there was no curfew, but you had to answer the 7 o'clock bell. My father said, it's time to go mow the lawn or take out the garbage or change the oil or whatever it was. You got to answer the bell.
Had to be there. So let's dig into some of the stories for the week. We have this week an organized list of Greenshoots and then Crabgrass. So we're going to dig into the Greenshoots, and there is a mix of property types in there. So we'll call out the different property types as we get into them. The first one is a story we saw this week of an acquisition.
Yeah, Prologis completed their acquisition of Duke Realty, 153 million square feet. That represents a sale price of $170 per square foot. Interestingly, the market volatility didn't undo this deal. Prologis came in with an initial bid of 24 billion. They actually sweetened their bid to 26 billion to get this done. We were talking to people this week in New York, and this is not an official number, but a whisper number that this represented a sub-4 cap. And that's, is there a bigger green shoot than that somebody is sweetening their bid and still getting a sub-4 cap in a market as volatile as this? A couple of other things we'll run through and try to go through these quickly. In Dallas, Goldman Sachs is planning to build an 800,000 square foot office tower. It'll be one of the biggest towers in Dallas in recent decades. Another sign of vote of confidence in an economy that, maybe not all that confident right now. In New Jersey, PTC Therapeutics took 360,000 square feet of space at the Warren Corporate Center. You're going to hear more about health and science as we go through this list.
I just want to point out that this corporate center, I could throw a softball to it from where I am. And I think it used to be the Lucent Technologies Center back in the day, and they're completely trying to pivot this whole campus to a Class A great place to work with a bunch of amenities and drawing people in. As someone who lives in New Jersey, I'd say if we can convince Trepp to get an office there, my commute would be amazing.
Yeah, Martha has a great arm, so it might be 400 feet away. So it's she can really throw that softball quite far.
That's right.
A couple of other life science type Greenshoots. Halozyme Therapeutics signs on for 73,000 square feet in San Diego. Icon Therapeutics signed on for almost 300,000 square feet at the Alexandria Life Science Campus in Millbrae, California. Running through the rest of these, at the Willis Tower, IMC, which is a tech-driven firm, increased their space by 50%. They're now up to 160,000 square feet. The Willis Tower. Cisco is considering adding a new headquarters in Georgia. If they do so, they would look to add 700 jobs there. That's a story from the Atlanta Business Journal's Savannah Sicurella. And lastly, Choice Hotels this week acquired the Radisson Group USA for almost $700 million. So Martha said this before, Lonnie said this before, deals still getting done, right? If we were in that panic mode, we would have seen things just come to a halt. And that's not what we saw. And we could go on and on. I think I read off 7 stories there. I had another 7 teed up, but because we're going long, I won't go through them. But there's just plenty of green shoots out there.
Yeah, just to add on the Goldman Sachs, that's a ground up, development. So that's new construction, which is, in this type of environment, is even more risky. Additionally, for Texas, that I think Caterpillar announced this week that they were moving their corporate office to Texas. And so that was like 54 of the Fortune 500 companies call their corporate headquarters in Texas, which was really great news for those of us down here.
Everybody wants to be in Texas,
Yeah.
Lonnie. What are you guys doing down there?
Well, it's like 102 today. So, I'm not sure. Nobody factors that into the equation. No state income tax sounds really great. 102 for 100 days, not so great.
Now we do have some crabgrass, so we will get through those, and they are a mix of office and mall stories.
So we said a moment ago, San Francisco, New York, Chicago will have vastly different outcomes than other cities. In Chicago and San Francisco, it seems to be a race to the bottom at the moment. 2 stories from Chicago. The first one from The Real Deal. The CME Group is looking to put 150,000 square feet up for the sublet. They're at 550 West Washington. This seems to be coming every week where, a company in Chicago is looking to give back space, particularly downtown. Elsewhere in Chicago, Blue Cross is moving to the Aon Center. That's good news for a CMBS deal that is backed by that particular property. But Blue Cross Blue Shield is downsizing from 220,000 square feet at 225 North Michigan to less than 100,000 square feet at the Aon Center. So 2 stories there about Chicago, which have a similar sound to them, people giving up space. In San Francisco, Square/Block, which is Jack Dorsey's company, they said that they're going to give up almost 500,000 square feet at 1455 Market in the Bay Area. That's just adding insult to injury for that market that has seen a lot of companies really try to give back space. In the sales market, UBS is looking to market 455 Market Street, which is a 400,000 square foot property at Market and First. UBS has owned the building since 1987. Why is this crabgrass? It's crabgrass because the San Francisco Business Times, Laura Waxman, is reporting that the building would have gotten $900 a square foot pre-pandemic, and now it's being marketed for $750 a square foot. So loss of, almost 20% of the value there. And we did have one in New York that popped up this week. We haven't seen very many credit issues, but we did see today Revlon filed for bankruptcy. Very little of this in the office tenant space over the last couple of years. We thought that we might see some of this because of COVID. We saw almost none of it. Revlon, a big debt load, lots of competition in the marketplace from new entrants to the cosmetic business, and supply chain / expense problems, all making them go Chapter 11. They're at One New York Plaza downtown with about 150,000 square feet. The bankruptcy filing gives them the right to reject the lease, but because they can reject the lease doesn't mean they will reject the lease. So stay tuned on that particular story.
And we have a deal of the week.
We do have a deal of the week. This comes from Cliff Barnes of the Triangle Business Center, and both a deal of the week and it's a green shoot. He calls it a bombshell deal in the Raleigh market. Mount Auburn Multifamily sold the luxury apartments at Foxwoods for $165 million. This is a 460 unit apartment at Fox Road and Fox Meadow Lane, just outside I-540. If you remember the Triangle Town Center, which was a defunct mall in that area, that's where it's near. But why is this the deal of the week? Mount Auburn bought it in December for $120 million. So a $45 million profit in 6 months. Good for them.
Yeah, this has to be another one of those 1031 exchanges or something where somebody has a bunch of capital gains they need to put into a property. It's not every day that you see a $20 million uptick in 6 months, even if multifamily has been as hot as it's been. This is, I gotta put my radar out and say there's more to the story here that we didn't get, but good news for Starwood.
And turning to shout outs, we have several. So bear with me. Tracy L. thanked us for the story on the Hilton Manhattan and had some follow-up questions on that. Brian B. wanted some office data in Minneapolis. Mordecai S., frequent listener, wanted a t-shirt. Private Eye Cap mentioned us on Twitter. BB Dogged, a frequent Twitter engager with us, and gave us a shout out for Office Talk and CMBX 6. And at CREFC, some of you that stopped by to talk to us, we really appreciate you doing that. Brad L. and Kate the Great at St. Francis in Union City are big fans of the pod.
Well, Kate the Great we haven't had many of these, but she is in the preteen area, I believe, or near teen area. We have a couple of real early adopters of commercial real estate news and data, and Kate the Great is one of them. And we heard that she took exception to one of our things where we said we were talking about a hotel and we failed to mention the renegotiation of the ground lease.
Yes.
And wow, kudos to her for picking up on a detail in a podcast. It's not the easiest thing to follow. So good for you, Kate. Keep it up. You have a bright future ahead of you.
Yes, she does.
I would say when Kate the Great gets to like 18, sounds like intern material for
real. Yeah, for real. David G, John, Rick J, Stephen M, Janie L, and a couple of submissions that included instrumentals like drum rolls and other things that we will be incorporating. So Deborah M provided us from Noxus and Grant, and Oz from Reverend Z provided us a couple of sound effects that you will probably be hearing soon, and we will definitely give them credit for doing that.
And one more shout out to United Capital and John Devaney, who threw a great party in New York last night. A bunch of Trepp people went. We were grateful for the invitation. Terrific live music from Devin Allman playing what is absolutely in my sweet spot, a lot of the Allman Brothers classic tunes. And, even in the darkest days, it just goes to show that there's always a silver lining. And yesterday it was 2 hours of great food followed by 2 hours of great music. So shout out to them.
Nice. And guys, this weekend, Father's Day, any big plans? Oh, wow. You're speechless, both of you. It's a surprise, I guess.
I was going to say, I don't want to embarrass myself by saying I didn't know that was this weekend, but.
Well, then.
My needs are modest. My cup runneth over. I don't need anything. I'm blessed with 5 kids, and that is the gift that just keeps on giving day after day after day. And in case you were wondering, I had nothing to do with their growth trajectory or development. It was 100% my wife. So, but yes, my cup runneth over. So if they let me sleep, as late as I want to on Sunday, that's good enough.
That's all you need. All right. Well, let me be the first to wish you both happy Father's Day and all of our listeners as well. With that, we'll close. Thank you to our producer today, Riley Cox. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send your email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Enjoy your Sunday, guys. Thank you for listening and stay well.
All right.